Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. This week, I'm speaking with Alyx Wood, Chief Investment Officer of Kernow Asset Management. Kernow describes itself as a contrarian investment manager specializing exclusively in UK equities, currently about £100 million in assets under management. Before co-founding Kernow in 2017, Alyx worked as a fund manager at Downing, a vice president at Deutsche Bank, and a management consultant at KPMG. Welcome, Alyx, to Merryn Talks Money.
It's a pleasure, Merryn. Thank you very much for your time. It's a bit surreal and a bit of a career highlight for me because I've listened to your show and now I'm on it. So, and I just found out you're half Cornish, you're Cornish as well. So this is perfect.
I mean, this is a career highlight for me as well, in that so far we have never yet had a Cornish person on who is a value-orientated contrarian who specializes in the UK. It looks like hitting every single button for this podcast. So we're more excited than you are, got to tell you.
Hopefully it's hidden quality, but yes, I totally agree.
Okay, so listen, tell me about why you started this fund. What's the key behind it?
It's been my lifelong dream since I've been investing since 15. I enjoy it. I love it. The opportunity set is amazing in the UK. The number of decent jobs and places you can practice this craft has been declining because of the growth of index hugging and businesses merging and forgetting how to make money. So the opportunity aligned. I got big enough and ugly enough to go for it, and so I did.
Let's go back to the beginning of what you said, that there aren't very many markets left where you can be properly active because the rise of passive has slightly destroyed the ability to do that. Can you talk a little bit more around that?
It's more the index hugging. It's a disease. 10 years ago, there were 400 UK, I'm exaggerating the numbers a little bit, but there were 400 UK managers that were doing plus or minus 10%. Now you've got 40 guys probably doing a decent job and everyone else is plus or minus 2 on the index. And that index hugging, that lack of conviction makes it very hard to find a job, because if you go join a big house or a medium house, you're tracked against that. And if you go too far away, you get fired. So, it's better to fail conventionally rather than win unconventionally. And you have to follow someone else's philosophy. To have your own philosophy and come out of an investment bank in your 20s, that doesn't exist anymore. To join, I'm not going to use names, but some of the great training programs that still exist, they just don't give you that career exposure anymore. There are places, the multi-strats are doing a pretty good job of the young people today, but the dearth of talent and opportunity is kind of frightening. The flip side of that is it creates huge opportunity, and trend following now is massive. The wisdom of crowd doesn't exist because of AIs to the same extent. So fundamentals and reality are getting a long way from each other, and there's a lot of crazy, interesting things, fascinating things going on today, and I'm chomping at the bit trying to capture all this and share it with people.
Okay, that's very interesting. So what you're saying is something we have heard quite a lot on the pod over the last few years, which is that the closet tracker never disappeared. There was a period when we all wrote a lot about closet trackers and we were infuriated by what they charged, et cetera, et cetera. And then there was a view that gradually that would disappear. But from what you're saying, most of the funds left in the UK that call themselves active funds are really closet trackers. And that's maybe one of the reasons why active has such a difficult time in theory. But the other thing that we have looked at recently is the performance of genuinely active funds. So if you look at funds with a very high active share, you tend to find a much higher likelihood that they will outperform.
Exactly. I would just caveat that it's the larger funds have got larger, as opposed to there's still plenty of active, good, high quality managers out there. It's just that the marketing machine has sucked it all up into the 20 largest. And that proportion of assets has then flown in. And then you also have fund flows from international investors pulling from small caps and all the rest of it. So you have this quite interesting distortion, and Calstone flows out of equity markets and all this. But
yes, but we still need to say it.
It just creates pockets of opportunity. And, how many people really do all the fundamental work and take a different view out of consensus? You're just not going to get paid for it. And I love it. So, looking silly and being ridiculed, making money doesn't go out of fashion. So that's what I'm going to stick to.
Okay, and how's performance been?
It's been good. It's been pleasing. I would have liked to have made more, but we've beaten the pack by a decent margin. That means we're starting to be taken seriously now. We've got to do another 5 years of that before we earn any sort of reputation. So, yeah, I can ask for more given how important it is to beat the competitors, but It's about sustaining that and maintaining that edge is the important thing.
Okay, so you found that you're in a position where you could start your own fund. Fantastic. And of all the markets in the world, you chose possibly the most unpopular one there is, and still is. I mean, like you, I keep looking at the numbers and thinking, this will come back. People are going to become interested in this again. It's going to happen. But even the most recent numbers, the Callisto numbers that you're talking about, showing where money is flowing to, we've seen one of the biggest movements out of UK stocks in record in January. I mean, hopefully that will have turned around a little in February, March. But it hasn't become any more popular in the last 5 years, but yet this is the market that you chose.
Yes, the causality is probably the other way. I used to invest in everything since I was 15. Then I specialised in 2012 in UK only because I get the culture. I have a very fortunate accounting background. I can get in front of anyone in terms of network. So it's an area where you can really build an area of specialism. And part of my philosophy is I spend as much time analysing shareholders as I do companies. So my specialism is I understand the flows and the makeup of a shareholder base very, very well. And I'm buying off distressed sellers and selling to greedy buyers. And I almost don't need to know about the company to make money. I do because it's a safety thing. And that's actually the core of what I find interesting. And so it's a product of history why I specialise in the UK. And just quickly touch on the UK, there's more 10 baggers in the UK than there's a percentage of market cap than the US. The distribution of curve, the flatness of the curve means you've got a lot of high quality, amazingly rated great businesses, Experian, Games Workshop, and then you've got a lot of dogs to make that work. The net result is you have a pedestrian, frankly boring market that does 4 to 6%. But the tails, it's fantastic. It's a stock picker's paradise, which is the weird dichotomy of this situation that we're in, that the discount doesn't close, as you articulated earlier.
I know that you are both long and short, and we'll come to short later, but what kind of companies are you looking for? Are you mainly large cap, small, medium cap? I'm guessing down the bottom end of the market cap spectrum.
We go where the value is, where the biggest opportunity is. So we have large caps, we have medium and small. Today we have a bias in medium because they're the high quality business with dominant positions. The management teams tend to own a big chunk and still sometimes be founders. You've been doing a lot recently on investment trusts. We've got 2 investment trust trades on. They'll disappear now. So we just move where the biggest gap is. Small cap is currently still, I think, primed to, you talk about turning. When small cap does turn, that's the best returning asset class in the world. If it doesn't, then we won't do a big proportion of it. There's some great large cap businesses, global businesses on a UK discount. We'll do them as well. So, we pay less for something, and then we trade the catalyst. And we'll move wherever the value is. That's why we call the fund the navigator.
And, okay, I have so many questions I want to ask, so I don't know where to start. Let's go back to the first thing you said about recently getting into 2 investment trusts. And you're right, our listeners are very interested in investment trusts, and so what are the 2 that you've bought into?
I can't
why are they
disclose one. The other one is Amadeo. Which is an aircraft leasing company. So this nearly went bust in COVID, just for reasons you can imagine. The 2 clients, one was very safe and the other one was actually in bankruptcy, but then that got bailed out. So then the covenants became good. We got interested in the asset class because you're trading at a 80, 60% discount and the cash flows are good. The catalyst there was the board and governance, and the other shareholders, Metage and Elliott, are incredibly smart investors, and that discount has closed, and you're collecting a 22% dividend that's now down to 13%, and they've been doing terrific buybacks. So it's a pretty great asset story, good governance change, and a wind down of the business over 8 years that will hopefully double our money.
Okay, so that was an example of looking at the other shareholders, the business, to find the catalyst for the value to be released.
Yes.
Yeah, okay. And then the next thing you said was about large caps and the global UK discount. And it's interesting, the idea that the UK has a discount is not generally accepted. Everyone refers to it. What do you think that discount comes from?
It's a natural oscillation of markets' perception of reality. That's how prices work and story. So the UK out of 2008, 2009 actually came out pretty good, relatively speaking. And from 2011 to 2014, the UK was doing incredibly well. You have to ignore America because it's been absolutely fantastic in India and China. Those are the outliers if you were Jim Rogers picking macro. But the UK has been the Brexit haze, as I should to be kindly call it, essentially was a middle finger to the rest of the world, and that perception caused money to essentially start flighting. And then you had a Woodford scandal, which would have hurt people having a go, COVID, and so it's just a general the natural buyers of UK equities has been declining, and pension funds don't buy it. So the retail market in the UK is really lower than, in terms of active buying as a percentage, it is lower than other countries. So you have to ask if that liquidity is not there, and then the companies have perception of lack of liquidity, and then they don't IPO, it then starts self-fulfilling. So we're in this self-fulfilling, self-harm situation at the moment. The companies are some of the companies are still amazing, and it just means you have a better opportunity to get. And it will turn, because things always change. We just don't know when or where.
You just don't know when. Yeah. What are you holding in the large caps?
We've got Hiscox, Frasers. These are probably more on the mid-cap ones. We've recently come out of Aviva. We've got Burberry.
Okay, talk us through that.
Burberry went from an embarrassing stock last year to hold to having a change of management. And that's interesting. So then you look at the luxury market and say, well, actually that's growing, and globalization is going to get bigger. It doesn't feel like it, but there's more people and wealth is going up, and there's more millionaires every day than there was the day before. Status and security, they don't sell clothes, they're selling status, and that only goes up with globalization. So the setup is great. The best luxury goods brands, obviously, in Europe, but I don't trade that. So Burberry happens to be the highest luxury factor company in the UK, FTSE 100. I can't buy Mulberry because it's too small and there's a shareholder problem. So the setup's very, very interesting. New management team, great tailwind asset. Then you're saying, well, they need to make money. What's the normal basis for their cash flow? What's the business valuation look like on all the fundamentals and all of that? And you get to about a 10 or 12 billion valuation. And the market cap, I think, was 2.5 or 3, which is quite a big gap. So then you need the setup to realizing that value, which is essentially what we're trading. It's the time value of money, because this could take 5 or 8 years to do 200-300%. And the strategy might be wrong, and you might have to recycle it once or twice. I've been watching Burberry for 15 years, and this is the only time I've ever been able to buy it. And that trench coat and that brand has been around a long time. And if you can make something for 30 quid, a scarf, and sell it for £1,000, that's a very high quality business.
Yeah, we'd all like to do that. So this is the way you look at it on your website when you look at your process. It's value the equity, acquire at a discount, which is something that everybody wants to do. But then the difficult bit is finding the catalyst. So what was the catalyst here? The change of management or a change in the shareholder structure?
So when I get in, I want to know who I'm going to sell it to. Burberry's my new Games Workshop. So when it's Toast of the Town and it's winning awards and all the income, and they're paying back the normal progressive dividend, we will exit, because then the normal buyers are back in. If you think about the register, you want to have a proportion of BlackRock X, Fidelity X. And if the register is close to what the normal register should look like, it can't move very much. If the register is a long way and they deliver, then the share price can move along towards it. It's a pretty much classic turnaround story. And so, you then come out the back of that, you need 2 or 3 good years of numbers going up. And then the greed comes back in, and then you exit. And you get the multiple expansion and the growth in earnings. And
you're happy to come out a little before the top. Leave it for everyone else.
I would love to be able to time tops and bottoms perfectly. I've never figured a way to do that without activism.
Without activism. So it's interesting, because that's not something that you're going to be able to do. So when you join the shareholder register of a company, you may be joining one where take the investment trust we've just been talking about, where you might have Elliott, etc., on the share register, but they're the activists. You might come in behind them, but not necessarily have a size to be activist yourself.
I think people prefer the quality of argument as opposed to strong arguing, as long as you get past 1 or 3%. If there's an activist involved and it's important, in Burberry's case, it's not that important. I'll give you a live example. So I'm looking at BP now. I'm not trading it. I don't think it's good enough. But you've got an activist in there. The CEO will get fired, and maybe the Rolls-Royce CEO will come along and take over the BP role. He's literally at the top, can't go any better at Rolls-Royce. He might as well take over BP, which is actually what he wants to do. That becomes very interesting, because BP can be tidied up and double in value without too much effort, and you shouldn't be ashamed of what it is. That setup is right there, and that's the stuff we look up, and we wait for these things to become real, where they can hit enough trade ticks. That wouldn't happen without the activist involved in BP being strong enough to basically get the board to do that. And it probably won't. Just I'm giving it probably
won't happen.
Yes.
Yeah. So that's an example of something that you would look at and you recognize the value, recognize the discount, but aren't convinced that there will be a catalyst in reasonable timescale.
Yeah, so there's hundreds of these and you just watch them. For me, it's like gardening. So the shorting is the weeds, the oaks, the things that make money, and then it's the change of weather and what's flowering and what's not. And just how do you spend your time on the day? It's about a time. You don't have to swing at everything. You've got to use your time effectively. And if I hold Burberry, there's no point in me looking at too many other retailers. I'll get more value going looking at some pharmaceutical businesses or something.
Yeah, so there aren't very many of you. I mean, you're the only investment manager / analyst at the company, right? So how many stocks can you look at?
My co-founder was an ex-head of equity research at an investment bank. We use 4 different outsourced research company. We use 2 referencing companies. We use a background check company. We have a quant outsourced product model. So it's a full offering. Our team and research depth, I hope, is an inch wide and a mile deep.
Do you worry about the operating environment in the UK in general? Awful lot of smaller companies in particular are going to have increasing troubles operating in a high tax, high cost of employment, high regulation economy. And that doesn't look like it's going to turn around anytime soon, which may limit the universe in which you can invest.
Am I concerned? I guess on a personal level, it's a bit disheartening. But then I take, do you want to be Singapore and Dubai, or do you want to be Switzerland and Norway? And both of those, one's heavily regulated and high tax and the others aren't. And what you want to do is find a place in society that works. So I think I was very proud of the UK when I worked in London because there was this globalization hotbed between great art and media and business. And they were so close, largest city in Europe. It was like combining East and West, the time zone, the immigration and acceptance felt really good to me. I really enjoyed that narrative as the UK, grown up. It was a nice place to be. Where I've kind of become a bit upset, I don't want to move into politics, is that's kind of feels less now. And we've sort of lost a bit of the golden goose, if I'm interpreting what you're saying. I go abroad a lot and I hear, UK's in structural decline. It's not very nice. It's wrong on the numbers, but my life would be easier if more great companies listed. Cambridge Quantum, and we lost ARM holdings to America and things. So I'd love to be part of the next revolution and the great companies of the future and be able to have that story over the next 10, 20 years. They'll still find a way. And we're talking about, this is all very marginal. From an investment perspective, it makes no difference.
Well, it must make a difference to profits, to earnings, if employment costs go up and if taxes go up.
Yeah, but if it's priced in or if I'm shorting it, then I'll make money on that side. If the multiple goes from FTSE All-Share multiple today is 15, if the market multiple of taxes go up, to your point, should actually be 10, then I'll price everything off 10. So, if we have a dot-com boom, then I can do 50 to 100% a year. If we have an income-driven 5% market, then I might be able to do 15% per year. So the opportunity to deliver and the dispersion definitely changes, and I can't control that. Would I like a crazy market? I think not every year. A stable one makes my job, frankly, easier. It means I can keep up and hopefully develop ahead of everybody.
Let's talk about shorting. So presumably that works in exactly the opposite way. Find something that's overvalued and wait for a catalyst and then short. Yeah,
preferably zero. So we do fads, failures and frauds. The frauds are the sexy fun one. Our big win was WANdisco. We discovered that £1 billion fraud. We've got a couple of others, or 7 others today that we've identified. These criminal enterprises, I feel a bit like Batman. I like going after them. We don't do activism. We don't make them public, apart from to our investors. And we just take the money off the table. And typically we wait for them to run out of money and to not be too clever with it.
Hang on, does this mean that you are not going to tell me what your criminal enterprises are?
I can tell you past case studies, but I will be shot by my CEO and compliance department. If you're an investor and you come in, I will tell you. But if you sign a document.
Only way you can find out. What's the minimum investment? What do our listeners have to pay to hear the stuff?
50,000. We put out 50,000 rather than the traditional £1 million. We wanted it to be big enough, but not be completely impossible for people. It's pretty much invite only on the platforms. My personal money's in it via AJ Bell, or you can go direct. And it's an onshore fund as opposed to offshore. We ticked as many regulation boxes as we were physically able to.
We talked earlier about large caps and the longs you held there, but our listeners are really interested in smaller companies. Have you bought any new small company positions recently, small or mid?
Last month we purchased Kistos. This is actually our smallest position, liquidity-wise. It's only 100 million market cap, which is on the cusp of what I can physically buy.
Tell us about it.
So Kistos is a oil and gas company. What's interesting is I think they're worth 350 million and the market cap was 100. So I did some work. Happened to know the management team for a decent time. Very savvy operators, own 20% of the business. They 42 bagged a previous similar incarnation on a previous company called Rockrose. The old shareholders in here have ridden this share price down from £6 to £1. The shareholder rotation told me that it was near the end. The fundamentals of the business, it's going to double its production this year. Its profits are going to not quite double, but get to 100 million free cash flow, which is the value of the market cap of the company. And then the catalyst to getting paid is the reserves they have for the wells that they're plugging into will also, they grade them. So basically how probable they're going to get them out, but they put them into the best bucket, which means they can double their cash flow for between 27 and 2030, which hopefully the market will value in some way. And so we should double our money if that's the case.
What's your average holding period? How long do you give things to come to fruition?
It's all different, but the average is 3 years. So it's further enough away that it's too far for analysts. And everyone's, at the beginning of the year, everything's in years, and I'm sure you feel this.
Yeah.
18 months is the furthest the brain kind of works. 3 years for us kind of is enough for perceptions of reality to change and new magical things to happen. So that works very well. 10 years is just too long for my attention span to make money out of the catalyst. And if you're wrong, you're holding something for too long then.
But it can also happen very quickly. And one of the things that we have been talking about on the pod recently is the extent to which it's now possible to have much higher turnover than you used to. So, even 5-10 years ago, the general idea was that you should trade as little as possible because those expenses ate into your performance. But now that it is really so cheap to trade, that's not really a thing anymore. And maybe there is a case for much higher levels of turnover inside active funds. And so instead of looking at that as a negative, now we should start looking at it as a positive.
It just depends on the edge you're trading. What value are you trying to capture and what's your edge? I will use Lindsay Train because they're a great manager that's having a difficult time, but his trading period is very long and his edge has to work on that because 80% of a return in a year is a rating return. If you're trading incremental growth of compounding of profit, you need to give it 5-10 years to become a significant portion of the shareholder return. It's impossible to do it any other way. If you're a multi-strat, their long term for them is a week. And they're very good at upgrading or downgraded earnings into news reports every day. And that's what they do. So it makes sense for them to have extreme turnover.
And Alyx, have you got any gold miners in there?
We used to own Centamin, which was an Egyptian gold miner. That got taken over 4 months ago, which was actually pretty good timing on reflection. So I'd probably be selling it now at new gold highs.
But you'd be selling gold miners, not buying them at this point?
Yes, I'm short a gold miner now. We're short AI, we're short copper and gold mining. Anything that's really popular, we're probably short.
So, Alyx, when I look at gold, which I've been keen on for years, decades actually at this point, slightly embarrassingly, it looks like the rest of the media has suddenly discovered gold as a thing. Central banks are suddenly replacing their treasuries with gold, etc. But when you look at the investment situation, retail investors, particularly in the US, haven't really moved into gold, and institutional investors certainly haven't. You're just not seeing those big flows into the ETFs. Beginning, but not really there. So it doesn't look to me like gold is suddenly super popular. It feels like it's more at the beginning than the end.
I think it's a fair observation. So I own gold physically, personally, because, it's a bet on government's collapse every 100 years. I think gold probably is close to be £5,000 or £10,000 if you look at what it brings, and it's been replaced by perceptions of other safe assets and other extremes, Bitcoin. Where we are with it is it's an enduring asset. That's great, but it doesn't do very much apart from protect. And given the last 5 years, you would have thought there should be a lot more protection going on, and it hasn't really been that bastion of safety. And then we've had the inflation boom. So, there's definitely an argument to have it as a balanced portfolio, and it would be strange not to for particularly a family office. In terms of trading it, we just look at the company. So, if the company's got a catalyst and they're overvalued on it or they're undervalued, then great. In terms of the commodity price, we can just hedge it out. So I actually don't need to worry about the price. We are actually short a gold mine today, which kind of sort of makes sense because they're currently in a high part of the cycle. The bull case I've just given you on gold in general, that has to then take in multiple expansion on the gold prices. Their outputs aren't going to go up, and if anything, they've got some problems. So really interesting situation. I suspect I'll still be looking at it in 10 years' time, so it's one that's worth spending some time on. It's one of the easier assets to keep a track of.
Alyx, I'm just going to guess here, but are you holding Bitcoin too?
No, I wouldn't hold Bitcoin.
You wouldn't?
It's not listed on the UK stock market, and it's a massive...
No, I meant personally. You said you hold gold. You said you hold gold personally. Is Bitcoin something that you would hold personally?
So I did buy it in 2012, and I did buy a house with the money. So I'm probably a bit of a hypocrite here, but I did it knowing that it was worthless and it was a bit of fun. It's a fascinating example of, every month I used to buy £1,000 and whatever from trainers. And if I can find invest in it, I used to put £1,000 in it before it took everything. And it's a good way to find new things. If I've heard about it, I'm probably a bit late if it's a young person thing, or a bit early if it's an old person thing. And so it's a fascinating way to plug in and pay attention to the world. And Bitcoin is a fantastic, it's probably a bit deep here, but example of how story can be the entire valuation of something. Stock prices are perception of reality, and story can have and religion have infinite value.
Okay, so Bitcoin is all story, but that doesn't make it not valid.
That's a much quicker, more articulate way of putting it.
Let's just talk a little about the difficulties of investing like this, because as you said earlier, it makes you feel a bit silly a lot of the time. It makes you feel unpopular, makes you feel like you're not with the crowd. And here you are sitting in what I think, and I hope you think as well, is a once in a generation opportunity to buy into a rather amazing market at a very low price. But nonetheless, no one has agreed with you for years. It's tough. So a lot of being a good fund manager is really about being able to sort of weather that emotional difficulty, isn't it?
I totally agree, and it's something that it took me a long time to fully appreciate. Part of the reason why Ed and I own the business is to defend against that. Part of the reason I live in Cornwall, it's probably overdoing it, but is to manage the lifestyle and fitness like an athlete. You've got to look after your brain. There's only so many decisions you need to make. It's a decision-based business. Those decisions need to be very good. There aren't many of them. They need to be very good. So you need to be in the best headspace possible to do that. And to defend yourself from, because you're going to be wrong a lot. And actually in contrarian, the way I do things, actually I'm wrong most of the time in terms of going to a party. So that can't get you and make you a negative person, triumph for the optimist. So I've set it up in a way to protect myself. And I think that will apply in different ways for different personalities. And really it comes down to, is the performance and the game more important to you? Or is it making money and looking clever and safe more important? And I think most people will be risk averse and should go for the second. To do the first one is kind of not worth it, like the return on headache in any business. And so there's something either wrong with you or you've got a point to prove.
You make it sound really quite hard.
The big change for me here is I never used to speak to the investors. So it was really obvious, just make money and do the best trade, right? Now I have investors. I don't want to let people down. I talk to very, very clever people who give me opinions that I have to try and ignore.
Mm-hmm. And then you have to explain yourself to them when things go wrong. That's hard.
We do. We're very transparent to the degree that we can. Actually, one of my best friends is, despite us making loads of money, he's flat. Because every time the market goes up, he buys more. And every time it goes down, he sells. And it's, it might change our relationship. And I've actually not let a lot of my friends come in for this very reason. And managing other people as well. I come in the morning and we talked about Burberry earlier. I started buying Burberry at 15 quid. I was buying it for a year and doubled it at 7 quid, fortunately. But along the way, emotionally, taking people on you that journey, you don't realize it until you have to do it. And it's very, on reflection, it's easy, but at the time, it's incredibly hard. You really are running into I run into a burning building and then buy the land to redevelop it the next day in effect. But telling someone you're running into a burning building is not that attractive to most people, even so. But if you're going to change the world and do something special, hard and easy, it's got to be hard.
You're still glad you did this?
Yeah, it's a life dream, and I'm very, very lucky. And there's so much more that we want to do. So much more.
But let me ask you one last question, and you didn't have time for prep for this, so if you haven't got an answer, it's all good. But are you reading anything at the moment that you would recommend to our listeners?
Thinking in Bets is what I'm reading right now, which is on my table. That's very good. It's an actually World Series poker player lady who then started doing touring and speaking to fund managers and CEOs about making a good decision and the outcome are actually unrelated. So you make a decision and the outcome's bad, you feel like you've done something wrong. It's called resulting. Making a decision is the important part, and that's the process you want to work on. The outcome of probabilities is a separate point. But emotionally, it's very hard because you focus on the outcome whenever you talk about a case study, not the quality of the decision. And it sort of reinforces, poker players get this, and that's quite an interesting reinforcement idea. So you want good quality idea, good quality decision, and positive or unlucky outcome. If you have a bad quality idea and you get a positive result, actually that can be a very dangerous situation because you then might try and repeat it.
Yeah. Okay, that sounds great. I haven't read that. I will get that, and I suspect a lot of the listeners will as well. Alyx, thank you very much for coming on.
It's been a real pleasure. I really enjoyed it. Thank you for the good questions. And hopefully we'll meet you in Cornwall next time.
Yeah, that would be great. That would be great, but not at the Seal Sanctuary. Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm at MerrynSW, and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It's produced by Summer Sadi and Moses Andam. Our executive producer is Brendan Francis Newnham. Production support and sound design by Blake Maples. And special thanks, of course, to Alyx Wood.